is that we always look for volume to be greater than open interest, and our scanners are filtered down to let us know when that criteria is met, and also that the trader somewhere is also looking to make a commitment of at least $50,000. So all we do is track the smart money and take the emotions out of trading as much as possible by piggybacking on these trades. So it's one thing to look at charts all day, and it's another thing to look at the option chain all day. So there's specific traders, which are the biggest traders in the world, like to use options to trade. So very savvy and experienced traders don't necessarily use charts to trade. You know, I know you see a lot of stuff about supply and demand, different zones, and that's all good when you're trying to utilize a plan. But for the most part, when you're trading options, you want to use as little as you possibly can to make as much as you possibly can. So that's the point of leveraging a derivative such as options. So this particular strategy calls for unusual option activity. So when we see things that are unusual, we want to make sure that we take note. We want to make sure that we track that particular option, because 9 times out of 10, somebody somewhere knows more than we do. And that's where we're looking to take our money, putting it with their money, and watching. So if we look at the option chain and we see volume greater than open interest right here, let's take a look at, we've seen a lot of flow on EWZ today. Right here, you can notice volume on the 27 calls expiring December 23rd, 8,300 contracts being bought. Open interest, which is how many were being bought the previous day or previous session, 742. Now, not all unusual option activity is made the same. You know what I'm saying? Because you don't know if it's an opening position, a closing position, or a hedging position. That's why we utilize industry expert information to help guide us through this situation. But just for starters, we have volume here on the 27 calls, the EWZ, which is an ETF, a Brazilian ETF. We have a lot of contracts being bought in this name. We have open interest, which is predominantly lower. So to us, that is considered unusual option activity. The reason that we want to pay attention to this particular contract is because it hit our scanners. So let's take a look at EWZ. We had 2 trades on this particular symbol today. The first one worked out. We were able to capitalize on this move right here below the VWAP. We were alerted on this symbol below the VWAP, and it gave us an opportunity to get in. Just watching this particular contract, this ticker hit our scanners. Even if we were skeptical on taking this particular trade, we have every confirmation afterward to get in. Here we have the ATR of 2678. We have our multi-day up here, which gives us a indication that we may want to go and revisit this price, because the market is ultimately rigged to price. And since market is rigged to price, we need to know those prices that the market is rigged to. So ATR is one, average true range, and then multi-day is another. And as you can see, even into the after hours, it still goes and revisits that price. So that is the specifications. And as you can see, noted on this chart, the average true range lets us know that we have a revisit at this point. VWAP lets us know that we have more buyers than sellers because we're above the VWAP. And then we get alerted here. This is one of our favorite patterns of the VWAP, the Kardashian bottom, where we have a fake out, a shakeout, and then a breakout. So we were also alerted into another trade on EWZ around this point here while it's holding VWAP, breaking this high, and we were able to get paid on this name twice in one day. All right, so that's the significance of utilizing unusual option activity, and that's why it is a nice strategy to have in your tool belt, because it works. As you can see, 8,300 contracts of volume today versus a open interest of 742. And then you can see it play out on this chart specifically. All right, so let's just go over hedge fund trading mastery, a little bit about this. What are options? Order flow, the key to profits, the unusual option activity trading plan, the Ichimoku cloud. What are the Greeks and why do they matter? The best order flow for you, the orders to avoid. So I'm pretty sure if you're on here tonight, you know what a option is. It's a contract between the buyer and the seller. These are two type of options, calls and puts. We know that. All right. 6 factors determine the option price of premium, the stock price, the strike price of the option, the time remaining until expiration, dividends, interest rates, implied volatility. Super important. In general, the more a given stock fluctuates in price on a daily, weekly basis, the more expensive its options will be, and vice versa. Options usually tend to be more expensive prior to earnings reports and other major announcement, but decrease in price sharply after the announcement once the uncertainty has been removed, which results in what they call IV, or implied volatility crush. A lot of people get caught in that because they don't understand implied volatility. It's super important. All right, so options bought as speculation or a bet will move in a certain directions. Traders buy calls when they believe the stock price will go high. Alternatively, traders buy puts because they believe the stock will move lower prior to expiration. All right, so order flow, the key to profits. Options aren't pure tools of speculation. Hedge funds use them all the time to hedge against stocks positions. If a hedge fund owns a lot of one stock but would like the option to sell it for a higher price, should it fall, they could buy a put option position on it to protect in times of market strife. So knowing the difference between options used as speculation and options used to hedge is everything when it comes to trading them. So every day I watch 2,000 trades in real time as they hit the tape. We always try to determine, are these orders hedge positions against a stock or a speculative play. So we learn to read the tape. A large part of the trading strategy is based on the ability to read the tape. By watching for big block option orders dubbed unusual option activity, we determine the positions as paper. So paper is the term originating from the trading floor. If you've ever seen those old trading movies, they always are going crazy, waving paper in the air. This is how they get orders filled. Nothing's changed. Everything is just digital now. So we need to see orders flowing in order to understand who's the big buyers in the room, what are they trading, and hopefully we can make some money on their positions, because of course they got more money than we do and we want to piggyback that, of course, right? So orders were actually written on paper and ran to traders in the pit by clerks. It's now used to describe large institutions such as hedge funds, mutual funds, or large banks. In other words, institutions who have access to better information, even insider information, than your average trader or investor like you and me. So when trading unusual option activity, I only want to take trades based on orders I believe to be speculative bets, not hedges, not closing positions. So given the sensitive and sometimes even illegal natures of their positions, hedge funds tend to be a secretive bunch. Thus determining these trades are speculative or a hedge is like piecing together a puzzle. That's why we utilize industry experts. So what if you could take the same trades as Steve Cohen the moment they were put on? Large hedge fund managers with billions upon billions under management. But I go to jail for insider trading, you might say. Not quite. The moment the order hits the tape, it becomes public information, and we can trade off of it based on our belief that someone placing a large bet has access to insider information. This is 100% legal. It isn't a matter of debate. Any SEC lawyer you know knows this is why we trade unusual option activity, and this is why it works. So the trading plan. So there's no secret to becoming a profitable trader. You should be skeptical of anyone who tells you otherwise. There's no magic money button. Making money in the market takes consistency, practice, and finding an edge that few others see or competent enough to use. So the tools you're about to learn are my edge. They've served me very well in my trading career, and without them, I would not have made the money I have. It's nothing fancy at the end of the day. With enough knowledge and dedication, anyone can learn these techniques. There's nothing really secret about it. Reading order flow and watching unusual options activity continues to be one of the most profitable techniques, just like it was on the trading floor. So, for example, if I had 2 very profitable years in Apple stocks when my net profits in Apple were over $1 million, want to know how we did it? Once a week for a year, a Merrill Lynch broker would walk into the pit and sell Apple spreads. So everybody knows this one particular trader in the pit. And whenever they saw him, they would go long and sell volatility.
Yeah, what? You got coming in there?
Hello? All right. So let's just think about this for a second. If we were on the trading floor, and I know we've all seen those movies. We've never been there. I haven't. I don't know if you guys have. But if we were on the trading floor of Chicago Board of Options Exchange, or if we were on the New York Stock Exchange, and we were selling, making orders, hollering out across the room, I need to fill this spread. I need to sell this, buy this. And we knew for a fact that the big players in the room, Mr. Johnson or Mr. whoever, they were the ones who had the most money in the room. And when we seen him selling Apple put spreads, what should we do? We should go long and sell volatility. That would be the mindset of any trader in a particular space. So, by watching that particular trader, we would be able to net a significant amount of money on just one stock, Apple. Okay, so that's just watching order flow by just piggybacking on those particular traders. So over time, by combining order flow with technical indicators like the Ichimoku cloud, we devised a trading plan, which is pronounced Oak Ribbit. This trading plan will give you a step-by-step method for breaking down unusual option activity. So after evaluating unusual trades with this plan, you'll be able to decide if you want to follow it or if you ignore the trade altogether. So the letters in the acronym stand for open interest, chart, risk, reward, break even, time, and target. Here you will see the importance of each of these elements in the plan. I want to show you guys this. Let me make sure I'm showing you guys. Can you guys see this trading plan? So the first thing being open interest. The first thing you need to look at is if the trade volume is bigger than the open interest in that line. So if you go to the option chain, you'll be able to decipher open interest. You'll be able to see volume. Let's kind of go back to it. Let's look at it. Here, the option chain, you got your strike price in the middle. You got your expiration date. You have your expiries, okay? And then here on the layout, you see volume and open interest. So we just went over this EWZ trade that we were alerted twice in one day, where we had a volume of 8,300 versus an open interest of 742. We go to the chart, we were alerted here, so we get to see it play out on this move. Below the VWAP is when we got alerted, got the best price. We have the Kardashian bottom, another VWAP pattern, fake out, shake out, breakout. VWAP letting us know that we should stay long. We get alerted for another price around here and capture this move here. We see multi-day up here. We got a lot of activity, right? All right, so open interest being the first part of the trading plan.
How did you know how to do that entry at the beginning? Like the first one
The
to the
first,
left of the chart.
okay, the first time we get alerted from our scanner. So everything that comes out on the scanner is time stamped by the SEC. This is just order flow, reading the tape.
Okay.
So now we were able to read the tape. We're able to step into the pits digitally instead of actually being there physically. You know, so if you think about all the movies you've seen in those pits where they're just flashing paper around trying to place orders, even one of my favorite movies, Trading Places, with Eddie Murphy, you can see where they're going crazy in the pit. So the same thing is happening today. It's just digital, where they're just trying to fill orders as fast as possible. So everything that comes out on the scanner is meets a certain criteria where volume is greater than open interest, which declares unusual option activity, and then it's also looking for traders that are making at least a $50,000 commitment on this specific trade. So the thing that separates just any old order, because you never want to take a hedge, and you don't want to take a closing position, because all unusual option activity is not made the same. We want to utilize industry experts to be able to decipher if this would be something that we should take. All right. Did that answer your question?
Yeah. So let me ask you this: when you saw it was so I'm new to the Discord.
Okay.
As a member, do you see it in the quant channel? If you weren't here, like, did you call it out in the channel or was it in the quant channel? Like, if you weren't here, how would I see that? You know what I'm
Okay.
saying?
Yeah. So these proprietary scanners are utilized by my specific group, Private Profits. Um, so me,
Oh, okay. Sorry. Gotcha.
yeah. So you could still utilize quant data. Quant data is an awesome tool for identifying order flow. But the scanners that we use are specifically tailored to a certain criteria that's separated from quant data. Um, all of this comes
Gotcha.
from, because sometimes I see quant data comes with flow after we get to see it. Because everything we get is coming from Chicago Board Options Exchange timestamp. So the orders that are coming out are orders that are being made at that point in time, right then and there. Not sure on how fast quant data gets it and pushes it out, but it's one thing to see order flow, and it's another thing to decipher order flow. And that's
So when you called it out, did you call it out in the Discord? So how do I know when to take be on the lookout for that? Was that you calling it out like in the trading room or
so these particular everybody that gets these alerts are either a student or a member of Private Profits.
okay, gotcha.
Yeah, and sometimes, if I see something, I won't specifically give out the certain price that we're getting it for, but I will let everybody, like you might have buyers in EWZ, you got buyers in Neo, Rivian puts being sold, which means go long, which is a bullish symbol to go long, sell volatility in that name. So it's just certain things that, my group has particular, but I will, kind of give an indication on where money is going in the Journey to Wealth Discord. Yes. So hopefully that helps. All
Yeah,
options.
and what's your call name in the Discord? Remind me. Is it Risk It?
Risk it. Yes. Risk it for the
Okay.
biscuit. Sometimes you got
I
to
like
risk it.
it.
Sometimes you have to risk it for the biscuit. I have my own channel in there, and I try to give out as many free trades as I can. Of course, nobody's going to be 100% accurate, but we want to make sure if I utilize a lot of industry expert market research, so I try to put out the best of the best, at all times. Make sure that we utilize industry experts at all points in time, because of course they know and been around a lot more longer than we have as retail traders. So I want to make sure if I get information out there, I want it to be the best information. Okay, let's see. So yes, EWZ was a big winner for us. Of course, we had a lot of bearish order flow today. I think another good winner was Amazon. I think I told everybody today Amazon had the 82 puts being bought, which is a nice winner. What is Amazon? All right. So of course we utilize VWAP, and we seen the market selling off early today. All right. We had a push down. We utilized the average true range, but here we see that VWAP is telling us to stay short. We have a retest of VWAP. Market is rigged to price, so we know we're going to get a revisit of VWAP somewhere today, and this would be our indication to go short. This break of the low of the day is our super reason to go short, because we just broke the low of the day at a VWAP retest. So if I ever see this pattern, and if you ever see this pattern again, make sure you utilize that as a reason to go short. We're below the VWAP, and VWAP just lets us know what side of the trade to be on. We don't want to be long if, of course, we're below the VWAP. So if we're retesting VWAP and we break down to the point where the low of the day, big institutional candle, medium institutional candle, breaking below to a whole new range. Now we're here. VWAP is kind of sliding down. We get another retest where shorts are covering, in my opinion. We don't go back to VWAP, giving us another reason to stay short. Oh man, I got 10 minutes left. But yeah, so we got 10 minutes left on the Zoom. I want to make sure I cover this. This is not supposed to be a VWAP training. Let's go back. So the trading plan, open interest, you want to take a look at that. The chart, the second most important element of the plan. Once an unusual option order is confirmed to be an opening order, you must then look at the chart of the underlying stock. Is the stock in a strong bullish or bearish trend? Is there support or resistance at the strikes the institution is trading as a barrier? Is it more likely than they are speculating on more upside or downside, or could they be hedging? Then you have your risk, reward, and break even. Once you determine the direction of the trade, you have to evaluate if the risk versus reward profile of the trade the institution executed is in line with your risk tolerance. So some trades could be far too risky for the average retail trader. However, since you know the direction the institution is betting, you can tailor a trade that has the right risk setup for you. So the risk of each trade must be measured against the potential reward. If the institution is risking $5 to make one, this is a trade you would want to avoid, right? All right. So you should always be aware of the break even of each trade. If there's significant support or resistance at the break even point, you may want to consider another strategy. So we would look at the chart. So let's just say if we got alerted here and we seen this line here, which would be resistance. So we know if we took a call, we would have to break this resistance, we would have to break VWAP, and we would have to get to that strike. So we have barriers in the way that would stop us from actually getting to that point. So we want to stay conscious of, do we have any points of resistance before we even take that trade, because that could be in the way of our plan. So putting the plan to work, once the trade hits the tape, utilize this strategy. Here you can kind of see what the scanners kind of look for. They put out the delta. They pull a bullish signal. We see how many contracts they bought, the expiration, the limit order that they put in, opening, just a little breakdown of what it looks like coming off of the scanners. Kind of breaks it down based on the criteria we're looking for. Open interest was an open position. Got to know that. If for some reason the trade was not labeled opening, we will be able to see the confirm that it was because the volume of 5,000 contracts is greater than current open interest in the line of only 796 contracts. With open interest smaller than volume, there are not enough open contracts in the line for this to be a closing trade. So it is confirmed opening. So the chart, does the chart indicate this trade is more likely to be a hedge or a speculative bet? We need to confirm that the underlying trend of the stock supports this as a speculative bet. If it does not, the trade may be a hedge and it is less likely to be actionable. So to do this, we use an indicator called the Ichimoku cloud. So everybody that has followed my private profits members and students have all our custom indicators that we use. Ichimoku cloud, ATR, multi-day VWAP. All of these pull specific data aggregation from the market. We've tried to compare it with other platforms, TradingView and such. It's not exactly spot on because it all is custom, so it pulls certain data. All right. So the Ichimoku cloud is based around moving periods and not moving averages. I got to kind of speed through this. We got 6 minutes left. Stock volume in UOA, and I did post this guide in the discords, my discord and Journey to Wealth discord. It should be in the trading floor, the Journey to Wealth. Make sure you download this, read it. It's not very long. It's a couple 21 pages, and it would definitely help you to understand unusual option activity and how to even use quant data. If you want to use quant data and you want to take that data, if there's a particular expiration um, that comes out on that signal, you bring it to your chart. You want to look at unusual option activity, volume being greater than open interest, and you can put it on your chart to see, would this be a good entry point for me? Is this any points of resistance on a bullish call or on a bearish call to if I wanted to take the 84 strike on Amazon right now, is there a point of support that would stop me from actually seeing my goal in that direction, or vice versa if I'm going long on a call option? So if you take the data, of course, quant data is awesome because you can see, what type of flow, what type of money is going into that particular ticker at that point in time. So you want to use that data, put it on your chart. If you have indicators that you use that are that you confide in or confident in, then you can actually see it before it happens. The move is being made. So if you see a bullish call, like if I were to see a bullish call on Amazon, I see the 88 calls being bought, and I just see a break of VWAP as the 88 calls are being bought. Then I know that there's smart money going into the 88 calls. I go here to the option chain. I look for volume greater than open interest, and it gives me an indication that I may want to piggyback on this trade. Hopefully I get in at a good price and make sure I take profits as it's going into the green for me. So even if it starts to turn over on me, at least I locked in something and I'm not turning a good trade into a bad trade. Because usually all these trades will give you a move. Not to say that everything is 100% accurate, but if you are, keeping your trade sizes to affect your risk management, then you should have no problem, giving the trade some time to work. Always be comfortable letting the trade go to zero if or when you put a trade on. You never want to put too much size of your account on any one trade. I'll always reiterate that because that is a big part of my strategy. I don't look to double my money on a daily basis. I always just look to increase my income throughout the month. Never want to put myself into a mindset of feeling like I have to trade, because you start to do crazy things in the market. You make bad decisions, making trades you shouldn't make because you feel like you have to. So we got 2.5 minutes left. Any questions before we get off? Any questions? Somebody give me one question. I'd love to answer.
Do you use your Ichimoto to, I just started learning that. Do you use that only for your entries and exits, or you said something ATR is something else on multi-day VWAP, if I heard it right?
Okay, so there's a few different indicators. We have VWAP, which is the volume weighted average price. It is the price of the market based on volume, and it's rigged to price, right? The stock market is always rigged to price. That's why you can always see it revisit certain price levels. So Ichimoku Cloud is based of different moving periods. It's definitely in that guide. I wish I had more time to go over it though, because there's a 26 period moving average of the highest and lowest low. There's a current price plotted for 26 periods in the past. So it's just giving you data from the past that you can utilize. So if it's above the Ichimoku Cloud, it's in an uptrend. If it's inside the cloud, it's in a neutral state. And if it's below the cloud, it's in a downtrend.
So you do use it for anticipatory entries?
You
Or is
can,
it
you can, a lot of people play the breakouts, the
okay?
breakout above the cloud, breakout above, below the cloud. So you can play them. There's 7 stocks that we look for to be above the 5-minute, at the open, the first 5 minutes of the open. Baba, Netflix, Facebook, Amazon, all the big names, Apple. We look for that to be above the 5-minute bar and above the Ichimoku Cloud to kind of get a sentiment of the market. How bullish is it? Like today, there was none of them was above the Ichimoku cloud on a 5-minute bar. So of course we had a bearish day. So it just gives us a sentiment starting off on how bearish or bullish the market might be. If we get all 7 setting off bullish above the Ichimoku cloud, of course we're gonna have a good day on the overall market. So yeah, you can play the breaks, of course, above and below. If you utilize Thinkorswim, you could go to the studies and look up the Ichimoku cloud and kind of just get a, play around with it for a little bit. It kind of looks like this. And that's it, y'all.